Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and join me to unpack your stock-related questions today. Schalk, PSG Wealth Old Oak, Alex Duys from Umthombo Wealth. Remember to be sending your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gents, appreciate the time. Alex, let's kick off with some banking updates. FirstRand yesterday, Nedbank today. Neither set in the world alight, but this is, pretty much what we expect from banks. At this point in the market, they're not set in the world alight. They're just, going along about their business, giving us decent returns and great dividends.
Yeah, I agree, Simon. Standard Bank also gave an update.
Yes.
I think specifically Standard Bank and FirstRand's updates can be seen in a positive light because they are in line with expectations. And they specifically Standard Bank's guidance of 8 to 12% earnings growth until 2028 and higher ROEs. If they can achieve that, then we think the valuation is still very compelling. I think operationally, FirstRand did quite well, and we are optimistic about 2026 and 2027 prospects. However, the big unknown there still remains the finding they can have in the UK.
Mm-hmm.
It's simply impossible to quantify at the moment. It does seem like it could be a very material number. But saying that, we think a big component of that's already in the price in our view. FirstRand probably would have traded somewhere in the 90s if this was not there. So we are, I guess, trying to be ahead of the curve there. And then Nedbank, I think it was in line with expectations. Nedbank, in our view, has got the highest geared to recovery in South Africa. So we think 2026, 2027 numbers will be a lot better, especially if SGDP growth prospects can go from, call it 1 to 1.5% or so. So I think overall, decent updates, and we are very constructive on the sector.
Schalk, the banks have had a fair year, but they're by no stretch expensive. And if, we're seeing green shoots left, right and centre. We've got some business confidence today that was up. We've had, off the grey list. We've had upgrades. We all those sort of things going in our direction. Lower rates, lower inflation. Good for the banks. The updates weren't thrilling, but there was nothing to worry about. And it's a space that still looks attractive.
Yeah, not to repeat what Alex said. Both Nedbank and FirstRand's been trading below, let's call it the year-to-date performances of the SA banks, for good reason. So FirstRand, we know that the fine or possible fine, and Nedbank naturally, we're talking about a 15% ROE compared to the other banks, like Standard Bank. 19-20%. FirstRand is talking about a 18 to 22% return on equity. Then, naturally, I think shareholders will go for the higher growing banks. And for that reason, Nedbank, if you look at the SA banking sector for this year-to-date performance been 13%. And just take in consideration, remember, year-to-date performances for the JSE, what? 37%. I'll take that any day of the year. We went into 2025. We were hoping for just a solid, stable year, and we're sitting on the 3rd of December. We're sitting 37% year to date. And you and I, off camera, had this conversation. You told me just to keep the market you're running over the December holiday, and it seems like I'm going to need this broad shoulders of mine. But you mentioned it. You mentioned the grey listing. You mentioned all these positives. We had the GDP levels. The numbers that came out yesterday, 0.5% growth quarter on quarter. That's the 4th quarter in a row that we've had positive growth in South Africa. And I know people will argue and say we should be growing 3 times the growth that we're currently growing. But at least this is a start. We've seen phenomenal mining figures coming out. The PGMs are doing good. Our gold mines are doing well. Copper mines are doing well. And all of this will firstly translate to a stronger current account. And ultimately, this will flow back into the economy, which will be really extremely good for banks. So I still remain positive on banks. I mean, as you mentioned, at the moment, you are sitting in an environment where you can actually earn more dividends by investing in Standard Bank than putting your money in Standard Bank's money market. That's a telltale sign. That's a telltale sign where you want to be investing in the banks and rather be putting money in money market.
You kicked open the copper door, so I'm going to squeeze a little bit more, and I'm not sure I can get an answer from either of you. But Philip asks, does Copper 360 need CPR? And I've got to say, when they listed with the share code CPR, I said that's going to hurt them. Schalk, do you have any insights on Copper 360? We know copper's a good story, but the miner's having a challenge. Any deep insights onto it?
No. I'm not going to even try and have a comment on a company that I don't really follow. I know copper has been in the buzzword. A few years ago, we've had lithium, and then before that, I mean, for now, copper is definitely in the buzzword. But copper, 365 or CPR, I don't know. Can't
Alex,
comment.
any insights on Copper 360?
No, unfortunately not, but I did see the recent update pretty much stating they need substantial amount of capital to really achieve their targets. I would suggest that if you want to invest in this, do some detailed research on your own. And if you want to pure copper players, obviously having better options to consider.
Yeah, 100%. I mean, it's one thing. The copper is in the ground. We know that because Goldfields was mining there 30 years ago. But getting it out is another story. Alex, Raubex announcing today that they're potentially going to be exiting the chrome business. I mean, it was always a little bit weird. And then, of course, prices really went against them. This surely good news for Raubex shareholders. It also means they're focusing on doing what they do, which is build stuff, construction.
Yes, agreed. So we actually do like Raubex, but the chrome of Alba was a part we do not like. However, we did anticipate a short-term recovery. So hopefully they're using the short-term recovery now in order to exit the business. We think that will reduce CapEx requirements. It will make it much easier to understand. Volatility will be reduced in the business. So certainly a good move in our opinion. Hopefully also some stage in the future, when Australia, the dust settles there, they could also look to exit that and rather have a more pure place construction company, perhaps also tied into Africa, that's just easy to understand, easy to monitor, and easy to understand the opportunities and risks.
Schalk, one of the nuggets in the GDP yesterday was fixed capital investment. Truthfully, mostly government rather than private sector, but they will come in time. And to Alex's point then, a focus on South African construction is not the worst thing in the world potentially. And Raubex has done well in tough conditions.
Yeah, we've had this conversation, I think last year, if I'm not mistaken, Simon, where we looked at the Stats SA data, non-residential properties being completed for that period, that 12-month period in 2024, and dating back to levels that we've seen in 2000, 2001, and that was the stress levels. Now we've seen this year, there's been a massive improvement, and we've seen it now in the GDP data that was released as well. It's also been fairly clear when you look at PPC and the recent update from Afrimat, that there's definitely some uptick from that regard. And I know the one is cement and the other one is tar, but Raubex is definitely, from an infrastructure point of view, is still in the forefront. And I agree with Alex. I mean, this will just bring focus to the company if it do goes through and the chrome do get disinvested.
Last time I'm going to ask you this question this year, Schalk, about Remgro, because we talk about it a ton. But someone did message me and says they're looking to take full control over Mediclinic. Ask Schalk, but I'm pretty sure he loves the deal.
I love the deal. I absolutely love the deal. I mean, it's not. I mean, it's not one of these things where you look at it and say, this will be a game changer. But others say, how do you eat elephant? It's like one bite at a time. And they've done a few things. They got rid of e-media this year. I'm talking about Remgro e-media this year. They definitely are streamlining things. I think one of the critics, for this company has been that they sort of lacked a bit of focus. Where they focus? Are they focused on the insurance side of outsurance, or the healthcare, Mediclinic? How are they going to bring it? And this definitely shows that they want the focus. They want to take full ownership of Mediclinic South Africa. Still the crown jewel, way more than 60% of the earnings from Mediclinic coming from South Africa. So they're taking full ownership of that. The Swiss side, it was always a little bit of a struggle. Nice recovery this year. Definitely helped the Mediclinic side to have a big improvement. But now that's going to be on the Hirschlander side. So I just like the focus. And you know, we had this conversation, I think, a week ago when I called it as my stock pick for the week. You know, still 40% discount. This is a company that's been trading at a discount to its intrinsic value of 18-19% just prior to COVID. Now that's what, 6 years ago. And I know, you know, a lot of people will argue, say, well, come on, Schalk, it won't go back immediately to the, let's call it 19-20% levels. But even just half of that, I mean, that's a 10% sort of mahala built into this company for now. So I do like Remgro, and these type of let's call it structures and restructures and focuses do help the company to unlock some value.
Alex, your thoughts on the taking over? I mean, essentially, they're taking South Africa for Switzerland.
We like it. I think one of the concerns investors had is that the valuation Remgro put on Mediclinic, and now with this structure having more ownership of South Africa, that'll make it easier to compare to relative to an care and life health. And I think, you know, that could then give more clarity to the NAV number, and perhaps the discount could narrow to that. Also, I mean, we're quite constructive of Remgro since Karel Vosloo, the Chief Investment Officer, has been appointed. And I think you can see all the corporate action that has happened over the last 12, 18 months. I think there's more to come. So we really like the business. We think they are well positioned at the moment, and there's still a lot of dry powder they can utilize going forward.
Question coming through on my Twitters earlier. British American Tobacco, boring but stable, worth a look with a great sterling dividend. Alex, would British American Tobacco be on your list?
Perhaps not now at the moment, Simon. We've been holders of the share for many years, and we've been aggressive sellers over the last few months. We think that the valuation theme has played out to some extent. There is a potential green shoot, specifically in the US, if you do see you know, some clamp down on the illegals there, specifically the new generation products. We know RFK in the United States is looking into those facets. So that's something to look out for. But we don't really like the medium to long-term story of the business. They all continue to dig here, which is positive. They've got a stake in India, which is quite good as well. We think there are better, perhaps, rand hedge opportunities at the moment, but certainly a safe place to be. Decent dividend, probably will still eke out the earnings. But for us, not as valuation enticing as it was perhaps 2-3 years ago.
Schalk, for you, some British American Tobacco. I mean, it is a dying industry, but they are managing to squeeze a lot out from it, and the new generation tobacco products are they're getting their place a bit, perhaps. Would it be something you'd look at?
It's been a dying industry for more than 25 years. So I think will it ultimately, you know, let's call it the original cigarettes business, will that eventually die out? I do think so. Yeah, it's like Alex said, not to repeat Alex, it's one of those companies. Firstly, I'm older, so I haven't sold my British American Tobacco company, and you know, one should look at why one should be holding it, because remember, this is a company that's been. I mean, I think you started off this conversation something on the line of, you know, it's boring, beautiful, or something like that. I mean, this has been a company, as boring as it sounds. I mean, that's actually increased by 48% year to date. So really boring company that's unlocked a lot of value for shareholders this year. But even as we stand here, this company that's trading at a 6% dividend yield. I do think, looking at 2026, not just for British American Tobacco Company, I do think one should be a little bit more careful. I think this year is going to be not as easy, and not that we thought 2025 was going to be easy, but I do think that where we're sitting now is we're sitting at quite elevated levels internationally, and one should be careful looking for defensive stocks. Now, that brings me back to British American Tobacco Company. British American Tobacco Company has always shown quite strong defensive qualities, very similar to your alcohol beverages like Anheuser-Busch. And you mentioned earlier, we talked about the healthcare sector. Some of our hospitals, Life Healthcare, Netcare, as Alex mentioned, they've been under immense pressure. I mean, if you just go and take the South African healthcare sector, and put that relative against the MSCI healthcare sector, international healthcare sector, then you'll see, the amount of underperformances our healthcare industry has had and have had in South Africa for the past year. Now, I know Aspen has been a whole new struggle, but I still believe, looking at some of these hospital companies, specifically Mediclinic through Remgro, that's a good opportunity. So for now, I would say BATS is a hold. One should be careful buying.
Alex, a question coming through about Sibanye Stillwater. A hold as it's got both gold and PGM's best of both worlds. Is it worth continuing to hold, notwithstanding I've done very well off it? This is one of these miners that has had a spectacular year. Would you still be holding him? And it's up, it's more than doubled this year alone. It has got the two commodities that are running.
Yeah, so it depends on the viewer's view on gold and PGMs. So I think gold's difficult to say where it's going to go to, but if it remains above 4,000, then that will be obviously good for Sibanye. And at Umthombo, we are very constructive on PGMs. So as a result, we think Sibanye is actually quite well positioned. They've also got a lot of depth in this, so that means they're able to deleverage quite quickly as the fair cash picks up. That'll further enhance share price performance. And Sibanye has been renowned for paying good dividends in the past. So we think if the cycle continues in their favor, Sibanye will have a very high beta, meaning it's very highly geared to the upside. But also be cognizant, if you are wrong, then Sibanye will probably have more downside than some of the other shares.
Yeah, these are stay close to the door type of stocks. Schalk, are you standing close to the door on these, or have you sort of thrown out?
No, let's make this a quickie. My view on gold. I'm still very much a gold bull, so you're going nowhere with my golds. And from the person's question on Sibanye Stillwater, when you turn the clock back 2-3 years ago, Sibanye Stillwater's the portion of EBITDA they made out of gold was below 10. It was like 8-9%. Today we're standing at close to 40%. So when you buy Sibanye Stillwater, you're pretty much looking at a company you're buying 40% gold and 60% PGMs. And I like both of them. I like both of those precious metals. So yeah, highly geared, definitely still on the higher debt side. But if you've got them, which I don't, I would definitely keep them.
Question coming through around the Foschini Group, in particular about their online operation, which is Bash, which is sort of all of their brands into one online store. And the question is, I like Foschini for Bash. Is it enough to make a difference? Am I trying to be too clever by half? Schalk, does Bash move the needle? I mean, online is getting bigger, but it's still quite small, I suspect, in most of the retailers' lives.
Yeah, I think that's the bottom line. I mean, the moment you look at the headlines and they say 55% of 55% growth in online sales, and when you look at the Foschini Group Africa growth on the online side was over 40%. That looks really, really intriguing. Looks really impressive. But it makes up about sort of 7%. Let's call it 7% of their total sales. So still fairly small. But I'm not going to repeat myself on the elephant story again. How you eat them. Eventually, we are going to see that going bigger and bigger and bigger. It's been a tough environment for the Foschini Group this year. I think it was, if I'm not mistaken, Mr. Shapiro's stock pick of the week 2 or 3 weeks ago, and I still believe that this might be some opportunity at these current levels. But yeah, not for widows and orphans. I do think that the economic environment is still only recovering. Our GDP has shown this. Our unemployment levels are still high. So yeah, I think as we recover, this should be good. And to only buy the Foschini Group for the Bash side, or let's call it online side, no, I think for 7%, you need to look at the bigger picture.
Alex, if we took more broadly on SA retail, they had a spectacular 2024, an anticipation of a good year. It's been a horror in 2025. Are you looking at some of those clothing retailers and thinking that there's some opportunity, some value here?
I would say we are lukewarm that sector. Our preference is rather for the banks, as I said earlier. But within the clothing retail space, I think there's a cap to what online can do, because a lot of people still actually want to fit the clothes and so forth. So I think that component is there. At the same time, store growth is still very aggressive from South African retailers. And you have to question, if you take a 10-year plus view, is that really the best allocation of capital? Because business models will change over time as online gets prevalent. So I think that's something to consider as well. And then within Foschini, we think they've obviously got an enormous sales base now to go all the acquisitions they've done in the recent years. But a lot of inefficiencies are crept into the business. Look at cash conversion, working capital, etc. So we would prefer them to start fixing the business a little bit. And if they can do that, then they can theoretically unlock a lot of value for shareholders. So there is that potential in them. While something like a Mr. Price and so forth, perhaps more geared to growth and recovery, and so they don't have that many efficiencies to solve because those are already well-run businesses. And our view, TFG's got lots of upside if they can do the right things, but they haven't shown that as of yet.
Question coming through. Please ask the panel what they thought of the Arixi, and I don't know if I'm pronouncing it right, used to be capital appreciation results. Those were out yesterday. A lot of moving parts with restatements. They also then issued a cautionary today. I actually asked the CEO if they were looking for deals, and he was like, absolutely. And it turned out he had one in the drawer already. Alex, for you, the Arixi or capital appreciation, did you ever look at? Is it one you follow? Is it one you have thoughts on?
Yes, we do follow it, and we do own quite a chunk of it, so we like it. Obviously, the payments business we think is very well positioned, and we've seen the announcement today. We'll see what the detail about that is about. I think the numbers, obviously, there's a couple of funnies in there with some restatements, 7 in fact. So we are still busy going through all of that, and our meeting with management tomorrow will ask some of those questions. And then if you look at the software side of the business, obviously the low point of the economic cycle. We've seen that as well with Altron, for example, and Roynet's businesses. So IT spending is really under pressure. But it does feel like it can probably pivot from this level. So we think Barrack's valuation is very attractive. They're currently in a net cash position of 300 million, paying good dividends. And it could be some corporate action that could either move the needle. So we are cautiously optimistic.
Yeah, and there was some life sort of coming through in the software business, and they do talk around getting some contracts going forward that'll help that side of the business, and they've sort of de-risked it in many senses as well. Schalk, I get your take next time. We need to go to Stock Picks. Schalk, are you going with Naspers?
There we go. I'm in the big cannon. We're sitting with the just before Christmas. I mean, last year this time around, I mean, I looked at Naspers as well. Not having a super year, China not having a super year, and ended up being a great company until I think it was about May, October-ish, October-ish, doing really well since the 6th of October. Which, funny enough, which is the same time where they did the share split. And funny enough, when a company do a share split, they usually want to make the company more liquid and more tradable, and usually it's got a positive effect. But this just did not have the effect that they wanted, because since the 6th of October, this company has now retraced 20%. And why it's also looking really interesting, when you look at this company since May this year, and you compare it to Prosus actually outperformed Naspers, and they're very similar. I know people say, one is more South African. It's pretty much, this still comes down and boils down to 10 cents. When you look at the two, Prosus has outperformed Naspers by 13.5% since May, and I think that's now given us an opportunity, not only in terms of an oversold scenario where Naspers is now currently trading, but also relative against Prosus. So if you own Prosus and you like being a little bit more active, it might be worth having a look at switching some of those Prosus to Naspers now.
Yeah, and it has been quite wild watching as you say, the share price depreciation after the split, because usually that's good for a share, but well, apparently not always. Alex, you're going with Karooooo with all the O's.
Yes, so at the moment, obviously very bullish on SA Inc., but I think when you do get opportunity to buy a quality rand hedge, you need to do so. So Karooooo, in our view, will continue to deliver good results. Before the last set of results were also actually in line with our expectations, but the share price has gone down from around 1,000 and sometimes even breaches 800 at the moment, right? So it's down quite a lot. We think that's a good entry point. This business generates phenomenal cash earnings as well as very good high return metrics. So it deserves its premium rating. And we think that rating will not only be maintained, but probably grow over time as they continue to gain scale. And they've got years of runway, specifically in Asia, that they can do. So we like it a lot for a long-term play.
Yeah, and all these vehicle sales that we're seeing can only be helping, because a lot of those cars, most of them, are going to get one or another different tracker put into it. That's all for Stockwatch today. Thanks to our guests, Schalk, PSG Wealth Old Oak, going with Naspers. Alex Duys, Alex Duys and Umthombo Wealth going with Karooooo. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.